All right. Good afternoon. It is today, Tuesday, July 12th at noon. Um, let's look at what's happening today here. Really, we have tomorrow, we have the CPI report coming out. So a lot of people, I think, are waiting. We've been just in this low volume chop in this market, just back and forth. Really, most people are talking about the dollar. That seems to be front and center on most people's minds. It started out much higher today, but it's come back down. So we'll see what happens. I'm sure that we'll see some big moves either way in equities, in currencies, and bonds after the CPI report. And then we'll see what happens for the end of month central bank meetings. So tomorrow, CPI report. Now, just keep in mind, guys, the CPI, it looks back 3 months ago. Okay, so it doesn't really tell you what's going on right now or into the future. It's a lagging indicator. All right, so it looks back 3 months. I suspect, and so is the consensus, that inflation will come in a bit hot this reading. I think the consensus right now is 8.8% year over year for this month. So, but I do think that by September or so, September or October, one of those prints, we're probably going to see something lower than expected. Already rents and real estate prices are coming down. We've also seen commodity prices level off a bit and come down, grain prices, food prices, as well as oil prices. So, it's been like this for a few weeks now. So what, 2 or 3 months from now? So that, gets us to around that September point. That's when I think that we'll see those lower CPI readings. And that's probably when we'll see the Fed pivot and potentially get a little bit more dovish. We shall see. Okay. Also, earnings season is underway. Pepsi has already reported better than expected earnings earlier today. The stock was up in pre-market, but now it's coming back to about break even. Bank stocks will soon report earnings, followed by the rest of the S&P. I am expecting that there's going to be some pessimistic guidance. This is an old CEO trick to lower Wall Street's expectations. This way they can bring down stock prices right before an options award. And generally, not generally, but a lot of companies have options awards in September. So this is a good way for them to lower the stock price so that they can get awarded lower strikes on their options. So this sets them up for a beat for the next earnings season. So after they lower expectations, they are able to, those hurdles are a lot lower to beat. And so after they beat, 3 or 4 months later, then their stock rises, and now all of a sudden their options that they were awarded are in the money. And this is something that happens over and over again. It's a very old trick. They wrote about this even 100 years ago. Jesse Livermore, I think, wrote about this. But it happened in the 70s a lot too. And, I always, compare this time period back to the 70s. I do think that as this bear market progresses, we're going to see this happen more and more. Now, just because it's a bear market, I know some of you are new and, some of you are not part of our Discord. You just watch on YouTube or Twitch. Some of you, have not really heard this view, but just because we're in a bear market doesn't mean we can't have mini bull markets that last a year or so. All right. I do think that just from the data, it just looks like we may see a mini bull market in 2023, back to a bear market in 2024. Usually things like this happen in stages. Okay, it's not really just a quick thing. Just give me 1 second, guys. Let me just try to update my screen real quick and close my window here. Give me 1 second. Sorry, guys, for that. They're doing some construction down the street, and I just heard some of their trucks roll by. So I just wanted to close that window. Okay, so yes, this is something that we've seen all throughout the 70s, and I compare this time to the 70s. Just because we're in this longer bear market doesn't mean we can't see mini bull markets. And we're probably going to see one in 2023, just from the data that I'm seeing. And then in 2024, I think inflation will probably come back. Commodity prices will come back in the next season. And when that happens, monetary policy won't be enough. They'll also have to make some fiscal policy decisions. Fiscal budget deficits are inflationary. So in order to cut the budget deficit, the federal government may have to raise taxes. Okay, so that's what I think may happen around 2024. And that will be, I think, the real volatility year. But we'll see. We'll see what happens. Right now, I think it's best to keep an open mind. I do think that we still have one more leg down this year. And then we'll probably see some stability. And then as the Fed pivots, then we can probably see a bull market year. Now, some of you guys are talking about day trading, and I saw some of you guys already day trading today. You know what my opinion is on day trading. For me, it's all about risk and reward. I want to be rewarded for the risk that I take. And I just don't think this is the environment for that. There is an environment. I'm not like anti-day trading. I do think that, with an effective risk management strategy, one could, effectively do, a good job of generating consistent returns. That's the point of day trading. You want to be consistent and you want to keep your losses small, because it will happen. There will be something that a curveball into your system. Market conditions do change, and these days they do change very quickly. One thing that I'm looking for is a rolling bull market. Okay, and we had one back in 2017. All right, back in 2017, we had a very stable market. All right, drawdowns were very small, and from one sector to the next, we saw this bull market. One sector would have a bull market, then another would, and then on and so forth. So we had this rolling bull market, and that is the type of environment that you want. So even though you're wrong, your drawdowns are very small. Okay, this was a very good environment, and also VIX was low too. So while let's see here if I can pull up the VIX. So as you saw there, in 2017, we had that kind of very nice trending line that was just going up. And here you see the VIX was very low. Okay, so premiums were really cheap on calls, 1 month, 2 months out, close to in the money. They were very, very cheap. Okay, and so your risk was relatively small during that time. All right, you could have day traded just calls. I remember for like 4 months, there was a time period where you just bought calls at the open, sold 2 hours later, took about a 1.5 hour break, sell for the end of the day pump. All right, and I did that for like 4 or 5 months straight. There is a time and place for that. I just don't think right now is that time. I do think, though, it's close. I think next year we might have that. I think we might have a rolling bear market and a volatility collapse, just from the options positioning on SPX. I harp about you guys learning about options. This is the reason why. You can look at market makers and you can see positioning. You can see how investors are positioned, and you can also see where the market maker will kind of need to transact in order to even out their books, just in case if volatility does fall. And if it does fall, I can definitely see us having a rolling bull market in 2023, and something like this where the VIX falls to the low teens, 10s, 11s, possibly. I mean, that's a little bit low, but we could definitely see an extended period of low VIX starting next year after maybe one more pop or something. Okay, so I'm just anticipating. I'm not trying to predict the future. This may not happen, but I'm just anticipating what may be just like a good chess player would, thinking about 5 or 6 moves ahead. Okay, so if we see volatility really collapsing and we start seeing this rolling bull market, that's when we'll start doing more day trading strategies. Okay, so but for right now, I think the big trades are the patient trades, the big weekly, monthly moves in this low liquidity market. So that's, there's a time and place for all these strategies. Okay, so I'm not anti day trading. It's just I just don't think it's, the reward to risk has to be there in order for me to do that. Okay, and it also takes up time too. So you want to be compensated for the time that you take for sitting in front of a screen and pushing all those buttons. You want to be compensated for that. So I don't want to be sitting in front of a screen and at the end of the day, all I have is just a very, very low rate of return. That's not an effective use of my time. So always keep that in mind when you decide on which strategy you want to use. Okay, so there's that. So CEOs are, I'm looking for them to lower those expectations. For the first 6 months of the year, earnings estimates have been going up, even though growth outlooks have been getting slashed. So for the past 6 months, CEOs have been raising their earnings estimates. This has to change. Even if we don't have a recession, I think they will have to revise down their earnings estimates. And what I'm looking for is about a 5% cut in earnings estimates. So that may cause a little bit of volatility. Again, I'm not trying to predict the future. I'm just anticipating. As you can see here, and this was published at the end of June, so it's quite recent data here. We can see that labor costs have been going up, material costs have been going up. At some point, this has to cut into margins and it has to cut into earnings. And so CEOs know this. Not only that, right now we're in this recession obsession environment with the dollar rising, and plus with the options award that they're getting in September. I just think this is a perfect storm for CEOs to guide their earnings estimates a little bit lower again, so that they can be awarded those stock options at lower strikes, so that they can set themselves up for the next ER. Okay, so I think all the conditions are there. The macro is there, the market conditions are there, also the September options award is there. So I think there's a lot of things going for this. So I do think that when these earnings calls do come out, they're going to be guiding lower, and we're going to see periods of volatility, especially with those big tech companies. When Apple, Microsoft, Amazon, when those names start coming out, I can definitely see them guiding a little bit lower and there being some tech volatility. Maybe with these bank earnings coming up, maybe we see the same thing. We'll see when that happens. Okay, so I do think that we might see some chop or at least some volatility entering the market with this earnings season. Okay, I have some other things here too. Inflation, somebody was today at the Discord, somebody was mentioning about the dollar, and how it seemed kind of ludicrous and high to think that the dollar could go up to 120. I think it's definitely possible. And as you can see here, as I said, I always keep comparing this time to the 70s. I always keep repeating myself, but the reason why is because the data is just overall so compelling. All right. And, as you can see here, inflation, just like I've been saying for weeks now, inflation can go up, come down, and then come back in a couple of years. We had a bull market during this time in the 70s. And again, everybody thinks that in the 70s, we had like 2 or 3 recessions from the 70s to the 80s. I don't see it that way. I see it as one recessionary period, one bear market that had a couple of mini bull markets in between. Okay, that's how I view it, at least. All right, and we had a mini bull market here while inflation cooled off. The Fed saw this inflation coming up, they tightened, and then as inflation cooled off, they started loosening again, and then a couple of years later, inflation reared its ugly head again. I think we're going to see the same thing. Inflation's coming up. It's the inflation story, and then the recession obsession, so they're going to loosen a little bit, and then it'll come back. Okay? It's just timing when that's going to be. That's the hard part. I think it's going to be around 2024. But we'll see. We'll see. Okay. So that is, a lot of the parallels to this. Okay. So in the same way, I can definitely see the dollar not having like a straight line path to 120 or even higher. And if it goes higher, I can definitely see us retracing back down into the hundreds or 90s first and then coming back up. Just like in the 70s. I think we're about this point right around here. Okay, we had the initial pump in the dollar. It came down. It pumped again. It went down, and it came back again. All right, and that last wave was the real big one. So maybe that's what we see here. I don't know. The history doesn't always have to repeat itself exactly. It just often rhymes, but it doesn't have to exactly happen like this. Maybe the big one happens now, and then we have some little ones in the future. It could be that. I'm just trying to think of all the possibilities here, but rarely is it a straight line up. It's usually these big multi-year, even multi-decade moves. So again, 120 doesn't seem so far-fetched when you look at this now, does it? Okay. Now, again, I don't think it's going to go in a straight line. I think it'll go here, maybe cool off a bit, get into the hundreds and 90s, and then come back up. Maybe around 2024 again, just coinciding with the inflation cycle, with commodity cycles, everything. So that's just what I'm anticipating for. Okay. So we'll see. All right. One of the things that I wanted to mention, a part of our data that we always track is junk bonds. What's really interesting is that junk bonds right now are giving us this strange signal here. It's been now, let me pull it up. Okay, here you go. So these are the advanced declines and junk bonds. And, on Discord, I always, post this every night. And this is the S&P 500, the orange line S&P 500 compared to the advanced decline line in junk bonds, which is reported at the end of the day, every day on the FINRA website. And as you can see here, now we've had 4 days in a row of advances. Now, keep in mind, just one little warning about this, and I said that too. What we're waiting for is 4 positive days in a row. Here's the thing, though. These are really small numbers. These are really small positive numbers. I mean, back in like the May bear market rally that we saw at the end of May that caught everybody off guard, we saw way higher prints of advanced declines, 800, 900, 400s. We're not seeing those kinds of large prints. They're very small. In the 100s, there's one day that was in the 300s, but this was only double digits. It was 58 yesterday. So it is positive, yes. But is it the signal that we're looking for? I don't think it is. It's still quite weak, even though it is positive. So I think we're still in wait and see mode. I don't know. Let's see what's HYG doing right now, actually. What is HYG doing? HYG was down yesterday too, and we still saw positive breadth. So it is up today. So, okay, we'll see. I mean, we'll see. I'll take it one day at a time, and I'll be the judge once I see it. And then also too, we have tomorrow's CPI report, so everything can change tomorrow with tomorrow's announcement. I think even though the expectation is to be high, we still don't know what the market's reaction to that is going to be. All right, even though it hits whatever the expected number is. I think the expected number is 8.8% from Wall Street consensus. So we'll see. It may change tomorrow. And again, it's so weak. The advanced decline. It's 4 days in a row, and out of last 6 trading sessions, 5 of them were positive. But again, it's just getting smaller and smaller, and it's the advances are just not that much different than the declines. So we'll see. We'll take this one day at a time. This is just one data point, guys. Okay, so don't be too fixated on this. We use this in a combination of other things too, in order to make that judgment on see whether this bull market has some legs to them, or if this is just going to be like something that happens for 5 to 10 sessions and then sells off. Right now, I don't think it's clear yet from just junk bonds. Another thing I wanted to show you guys was a default rate in junk bonds. Right now, the default rate is still quite low. Okay, if we really want to see a washout, we just haven't seen anything like that yet. We just haven't seen anything like that. All right, so I think the Fed is also keeping an eye on this. And so what could be is that the Fed is just watching this, and they want to see this higher. Okay. Now it can change. This can change, relatively quickly. I mean, maybe within the next few months. Again, that's why I think the pivot may happen in September, October. Maybe in the next couple of months this goes up. But I think that's what they're looking for. They're looking for these defaults to increase before they start talking about loosening. All right. So maybe they loosen toward the end of the year. Maybe they start talking. Maybe they start getting more dovish later than that. It could be. And I know they're looking at this. All right. Some of the other things that we're looking at also, and again, these are, I know a lot of you guys don't trade junk bonds, neither do I, but, this is, I think, a very good indicator of a lot of risk assets, not just stocks, but also crypto. I know a lot of you guys are crypto holders, Bitcoin, Ethereum, and such. So, I think all of this can help us determine when to start legging in or when to go with the trend. Right now, the trend in risk assets is down, okay? So just to keep the perspective in mind here, all right? Oh, by the way, since I have the SPY chart up, I mean, right now, again, the long-term trend is down. All right. So I think this is going to help us. All this analysis in junk bonds and fixed income is going to help us time some of this, and perhaps give us the confidence that we need to hold certain positions to see them play out. All right. That's what I'm using them for. But anyway, remember how we were talking about those earnings guidance changes? If they guide much lower than 5%, these lines are going to start moving. Okay. They're going to start shifting down. All right. So these are based on earnings guidances. Now, I personally was very conservative in earnings growth. With some of these lines on the bottom, I was very conservative with them. So maybe these bottom lines don't move as much, but definitely this line will. If it guides more than 5% lower, this line will move a little bit lower. Okay. So in a couple of weeks, we may see this chart change. We may see these lines shift downward due to just expectations on earnings, because these lines are valuation lines. These lines are based on earnings multiples on earnings estimates. And these are just levels based on where interest rates fall. If interest rates go higher, we're going lower on these lines. So yeah. Again, I will monitor that and I'll let you guys know, but I just wanted to let you guys know that the plan may change, okay, if they guide much lower, okay? I don't see it guiding much lower than 5%. I just don't see that happening. It could. So we'll see. If it does, I will let you guys know and revise this chart, okay? But again, the big trend is down right now, all right? The big trend is down. All right, some of the other data that we're looking at, let's just go through them right now. TIP, TLT, breaking down again. Inflation expectations are coming down. So we may see some deflationary pressure, possibly, and we've already been seeing this. Commodity prices coming down, grain prices coming down, energy prices coming down. US 30 minus 10. This gives us the long-term minus shorter-term spread. If we want to see the economy rebounding, we want to see this steepen. We want to see this go up. Okay, bank earnings are coming up, so we might as well take a look at this too. It's the 10 and 2. Oof, getting inverted. getting inverted. Look at that. Not good. So definitely, okay, so back to that earnings thing, back full circle again. I can definitely see Jamie Dimon and crew and all these other bank CEOs. I can see them guiding much lower because of this, saying, oh, yields are inverted, it's going to be much harder to monetize, and the margins on loans are going to be much worse than expected, blah, 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 and guide earnings lower just to set themselves up for a beat next quarter. I can see that happening, especially with this. This gives them an excuse to guide lower. This is a very good excuse for them. Okay, I would, it's very doubtful that they're going to miss this chance to do that. Again, they're incentivized to do this, so this gives them the perfect excuse to do it. Okay, how's XLF doing? Usually we see a pump before earnings. Oh, it's still pumping. Well, there you go. I think Thursday is when JP Morgan announces earnings. So generally a week and a half before JP Morgan announces earnings, we see XLF catching a bid. I'm surprised it's actually catching a bid even with yields being inverted. That's kind of surprising. So we'll see. We'll see what happens. How's JP Morgan doing? Yeah. Actually, they're the most correlated to that 10 and 2-year spread. I'm surprised. Huh. Stanley, Bank of America, Citi, and Goldman Sachs. Huh. We'll see. See what happens. Oops. JP Morgan again. Okay. So it's doing about, they're all doing about the same. Much higher than the index. So maybe maybe it's some of the smaller regional plays that are bringing it down, or stuff like fintech maybe. Okay, well, anyway, I am getting off track. Okay, so data, let's take a look at that. So yeah, 10 and 2-year inverting. Don't be surprised if we see banks guide lower for next quarter. Growth versus value coming down. Okay, so we're seeing a little bit of a outperformance in tech getting subdued today. So let's just take a look at some of our sectors and see what's going on here. Let's see. Oof. Okay, metals, home builders, real estate, retail. Okay, so these are the sector leaders today. Okay, so we're seeing value catching some bids. Okay, so and we're seeing them outperforming growth just for today and yesterday. So we'll see if that continues. It's still an uptrend. I think if we do see a bull market rally, if we see a bear market rally, I still think growth is going to outperform. Okay. And you know what? I even think if we have a sustained bear market rally, IWM may be doing well. This last June rebalance, a lot of stronger companies entered into the Russell 2000. I'm actually quite surprised at how resilient that index is. So, we'll see. We'll see what happens. But I do think that growth, if we see a bear market rally, if we see a bear market rally, this growth will outperform value into that rally. But again, in order to really see that rally, all eyes on the dollar. We really need to see the dollar come down a little bit, okay? And if the dollar comes down a bit, I think that's just a seasonal thing. I think it'll roar back maybe in a year or so. But, this is not a dip by any means, okay? This is just a mild pullback. I really want to see it break down, okay? Maybe get into below 105 or so. then maybe I'm convinced, okay, maybe the dollar has paused. This is nothing. This is just noise. It could still keep just going up tomorrow into the next day, on and on and on. All right. So this is still in an uptrend, and it is just accelerating. So we'll see. At some point, it does have to cool off, but it may not be today, it may not be tomorrow, it may be a while. So it's hard to put any risk on this trade. If you're trading the dollar index futures, there's really no trade right here. I mean, if you're long and it corrects, when do you really see yourself? When do you say you're wrong, right? Let's say you're short and it keeps going up. Well, when do you say that you're wrong? When do you manage risk? There's no effective way of managing risk, long or short, on dollar index trade. All right. Speaking of the dollar, as long as the euro is coming down, all right, as long as this euro is coming down, dollar's going to have a hard time coming down. All right. Actually, I think, did it get to parity? Oh, it did. Oh, look at that. 1-to-1. It did get to one, a little bit below. Every brokerage is different. Currency markets are decentralized. So depending on your broker, you may see a different print. But according to TD Ameritrade, we saw it just dip 1 pip below. Interesting. Let's see if this continues or not. I mean, this is something that they've been talking about for 2 decades. Is it? Yeah. I mean, they've been talking about this for 2 decades. It coming back to parity. And finally it did 2 decades later. Nice. Is there more room? I think if this energy crisis in Germany continues, then yes, definitely it could. If German industries are forced to stay shut for longer periods of time, we could see this go much lower. All right. Their current account surplus is what justified them being over $1. Without that justification, it's hard. And especially with extended shutdowns, and if there's some major problems to their economy because of this, then I can see this coming down, maybe even testing these lows. Possible. We will see. We'll see what happens. But if that does, then I mean, we could see some more headwinds for energy and other commodities. Wow, look at that. Oil not giving us a chance at all, not one bit. It came back up and it just couldn't get over it. It is what it is. If the dollar drops though, I do see this as tailwind for oil. I think if the dollar drops to like under that 105, we could see it come back. We could see oil come back to these levels. Still possible. But it seems as if we missed our oil short. That's too bad. Corn. Oof. Wow. So that was the retrace. That's it. That was a retrace. It didn't come back to our 720 level. That's unfortunate. That would have been a nice short. Oh, well. It is what it is. I know today a lot of people have been talking about gold as well. Gold, if you guys remember, I bought gold, some call spreads around here. And I said, if it closes below this level here, I'm out. And I got out here around the 1770, 1780 or so. I got out. So obviously I was too early. Or I should say I was wrong. So I still do think that gold is going to come up. I just think it's going to take some time. The dollar has to really come down. This was kind of my hedge for just in case if the dollar dropped and it sent EEM up. I don't think that's going to happen. So, it was a very small position. So it is what it is. But I do think maybe end of the year, maybe early next year, This is when we could see a reversal in gold. One of the triggers, again, I keep telling you guys this, the lie detector and one of the leading indicators for metals and for China is Australian dollar. All right. Right now, the Australian dollar is in a downtrend. So I think, most of the metals are still going to find headwind because of this. It's not until the Australian dollar really reverses its trend and starts going up. That's when I think gold and all the other metals will start having more sustained bull markets. All right. When this turns, that's when I'm also going to start looking into uranium plays, longer term uranium plays. All right. So I am looking for that opportunity right now. If this turns, I'm going to start looking into uranium. All right. Australian dollar is coming up. What's going on with FXI? Still down. Okay. It's still down. China having some issues with their COVID numbers. They closed Macau down for a week. It sent a lot of the casino stocks down. We'll see if they it recovered a lot of its losses actually. It's a strong day in the Australian dollar, so we'll see. I don't see that one day in the Australian dollar as a reversal. This is not a reversal at all. This is just a little bit of short covering, I think. And then I think it's going to continue downward, sending FXI with it. All right. CEW, which is the ETF for foreign currencies, for emerging market currencies, is down. We're down for the day, recovering some losses, but it's still overall downtrend. All right. That is the reason why I am still holding those puts. I'm at about a 20% gain so far. We'll see. I still think this goes down. It may chop around for a bit though, especially with the inflation numbers coming out, FOMC earnings, all this. It could definitely be a little noisy, but I have until March. That's why I put some time on these trades. Most of my FXI puts are in the November puts, so I still have time. So we'll see. We'll see what happens. Okay. Let's take a look. I know a lot of you trade Bitcoins, or into cryptos and Ethereum and such. Oops. Give me 1 second. I just had it up. What happened? There we go. Okay, so just looking at the data here. A lot of retail participation in the last day or so. As we can see here, more puts are getting bought. So there's a little bit of a risk-off sentiment in crypto for the last day, as evident by the price coming down. And again, I told you guys that my thesis is that the Bitcoin market is seeing a lot of institutional participation, like the S&P 500, like SPY, and we're seeing a lot of dynamic options hedging happening, where institutions are and market makers are hedging their order flow, with options, and all these options orders are also causing market makers to move the underlying. All right. So one example is if a market participant buys a put, the market maker has to sell a put. The market maker always wants to stay neutral. They don't want to make money off of price changes. They make money off of the spread and the time value of those options. Okay, so the market maker selling a put is a bullish position on the market maker's books. So they need to sell some Bitcoin, short some Bitcoin, in order to make their book neutral. Okay, same thing if the investor sells their put, the market maker has to buy a put. Buying a put is a bearish position, so therefore they have to long some Bitcoin in order to even out their books. Already, in SPY and in indexes, you're seeing this. You're seeing this in the U.S. equity markets. I think Bitcoin is starting to see that. Okay, so we're starting to see some more puts being bought. It looks like the July 15th, 19,000 put July 29th, 19,000 put, 16,000 put for July 29th. So these three right here is a July 29th and July 15th, 19,000 strike and 16,000 strike. So those are the strikes that we're wanting to look at. It looks like we're seeing a lot of participation in that. Okay, so let's go and take a look and see what the volumes look like for those strikes. Okay, let me go to boom. All right, volume. I don't want to see. I don't need to see that. No positions. Okay, good. So again, we're looking at the 15th, which is 2 days away. So we got the CPI numbers coming out. I can definitely see some hedging happening because of that. Puts are here. So yeah, right there, that 19,000. So we're seeing a lot of puts getting bought here. Okay. I checked the order flow not too long ago as well. So I did see there being a considerable amount of puts getting bought for this weekly as well as the end of month. So we'll see. I think, we're seeing some call volume here. I wouldn't be surprised if that's calls sold. They sold these calls to buy these puts. Do a little strangle. I'm not strangle. I'm sorry. A collar trade. Okay. A protective collar where you sell a call and you buy a put. So let's look at the end of the month. So definitely seeing some demand. 19. So these are the strikes we were looking at. 19, 16,000. Lots of OI build up there. If we see, again, these are pivot points. By no means are these reversal points. I mean, it could be. Those pivot points may be places where we see huge reversals, or we could see mini panics. Okay, so it really just depends. For example, on the 15th ones, if we see that in the next day or two that Bitcoin just sells off and we still see this huge OI here, the market maker or whoever is short on these puts are going to feel that, because as we get closer and closer to expiration, the gamma effect on these options just becomes stronger and stronger. The changes in delta for every point change in Bitcoin, it gets harder and harder to manage that risk. So people that are short options, especially if we see a huge sell-off coming in Bitcoin, and then we also see this volatility reading go up, and we see a huge number of put buy orders come in, this could be a point of where it panics, where we could even see further selling. So we, sometimes when you see those candles, wicks, and you see those huge wicks down, we could see something like that here, especially around 15,000. If it reaches there within a day or two, I can definitely see, or even here, if it breaches 19,000, we may see a big wick down. For all these people who are short these puts, panicking, they have to cover because now the gamma is working against them exponentially. So now they have to cover their short puts as quickly as possible. So it even drives even more put buying. So more market makers will have to sell them those puts and short the underlying. So again, these are areas where we could really see some panic, especially if the moves happen closer and closer to expiration and we still see those big OIs. Okay, this really increases the chance of having those mini panics happening. All right, because as that gamma effect becomes stronger as we get closer to expiration. So since gamma is much higher around expiration, your deltas change very quickly when price moves against you. And so in order to effectively manage that risk, they're just going to buy back those puts. So when there's a lot more put buying on top of put buying, that's when we see those mini panics. Now, on the flip side, if we see that the volatility is decreasing and we're seeing prices increase, then a lot of people may cash out their hedges. They may sell their puts, buy more calls, and that will beget more buying from the market maker. The market maker will have to buy in order to take on all those bearish bets, because as people are selling puts and people are buying calls, the market maker has to sell those calls and buy those puts, which are bearish positions. So to even out their books, they're going to have to buy bullish positions on the underlying, which means buying more Bitcoin. Okay? So there's two scenarios like that. So that's why these high OIs are not always reversal points, although it could be. It just depends on the order flow and the volatility reading. But again, as we get closer and closer to expiration, especially these July 15th, there's only 2 days left. If that gamma becomes unmanageable, then we're going to see a lot more put buying at those points. Okay? So if you're day trading this, keep an eye on that order flow list. Okay, keep an eye on this and keep an eye on volatility. Okay, that's going to be very important for you guys, for day traders. All right. Any questions? Oh, I see some people here. All right, let's see. New home builder stock pricing, assuming a 17% drop in either revenue, selling homes for lower, or increased buyer incentives on a forward 12-month earnings. Sounds about right. Again, today what I talked about earlier in the video was that I think earnings guide. I think companies are going to guide lower. I guess it's already happening in home builder stocks. I'm kind of surprised it took them this long to guide lower. But I definitely, tech stocks, bank stocks, all these stocks, I can definitely see this quarter them lowering those revenue guidances. They've been raising estimates for past 6 months, even though they're slashing growth estimates. It's time now, even though there may be no recession, which I think is a very, very wishful thinking to think that there's not going to be a recession. But let's say there isn't. They still have to cut those earning estimates for the next 12 months. I think 5% is reasonable. It's a reasonable cut for earnings estimates. Okay, that's just what I see, and I think they're going to do it this round. I think there's every excuse to do it, especially again with the incentives that CEOs have with their options, awards. I can definitely see it happening for this quarter. Yeah. Before we go, unless there's any questions, let's just go over the positions one more time. Okay. As always, I like to show you guys what my positions are. I'm very upfront with you guys. I hope, at least by now, I hope I've earned your trust in that. I don't sensationalize things. I say what I mean what I say. So UVXY, I'm still in those call spreads. I'm long the 15 strike, short the 20 on those 15-20 spreads that we got about a month or two ago. Surprisingly, those are still in the profit. Again, why? Because I used skew in my favor. There was a 10-point skew differential, and the short strikes decayed faster than the long strikes. I also bought those 14-24 call spreads, long the 14, short the 24. Those are still around break even though I bought them about like 50, 60 cents higher about a week ago. And again, the skew, all right? The short strike decayed faster than the long strike, okay? Math, it works. Put that math in your favor. What else? FXI, I'm still in those crummy August ones. If I had used spreads and not have been an idiot, and the reason why, I'll tell you exactly the reason why I didn't buy spreads when I first legged into the FXI puts, because I got jealous. I saw other people buying puts without a spread and making those huge returns. I was like, yeah, I'm jealous. I want to make those, I want to make that too. That's stupid. I should have, China is just one of those things. It's really hard to chart. It's really hard to time, because sometimes they come out with data dumps, or the media, they'll come, the Chinese state media, they'll come out with some announcement that the government will prop up the economy at whatever cost, and those usually will send, people on a buying frenzy, at least on a temporary basis. But again, I should have legged into spreads. And if I had legged into spreads, I'd probably be about 30 to 40% ahead rather than 20% ahead right now. Most of it, though, is in my November spreads. I'm still in them. I'm long the 31, short the 26 puts. overall, even with the losses on my August puts, I'm about 20% ahead. So, but I think there's way more meat on those bones. Okay, especially if that Australian dollar just keeps on tanking. All right, EEM, we're up on EEM. I have until March. We're up. My cost basis is in the 270s, so we're up a good bit. Again, a lot more meat on those bones. I think, just personally, and also too over the weekend and yesterday, Sri Lanka just collapsed. They're having really big issues in Sri Lanka. Their prime minister or their government basically has abandoned the country. They stormed into their version of wherever their prime minister or their president lives. I forgot what they call it, the presidential palace or whatever. They stormed in. The people stormed in. They stormed into other government offices and they protested. And right now it looks like they have no standing government. I believe in the Sri Lankan constitution, they have 30 days for the parliament to pick a new leader. Okay, so that's the state right now in Sri Lanka. I think other countries are about to follow. Other emerging market countries, they're going to follow. This is just the first crack. It's that cockroach theory. You see one cockroach, there's bound to be more. There's one problem, there's bound to be more. There's bound to be a lot more countries. And I think China is also about to head there if they continue these no COVID policies. But we're seeing, in the emerging market currencies, that the currencies are getting sold off, especially with this dollar strength. I'm not saying that EEM is going to go there, and that's not how we use CEW. CEW, you look for CEW with trend changes. Usually you see a trend change happening before EEM. That's how it's used for. But just because CEW is back to its COVID lows does not mean EEM is going to go there. Okay, that's not how this is used. But having said that, I think there's a good chance that this may see low 30s. I think there's a very good chance. Okay, especially if China sells off too. Oh, if we get 2 payouts, FXI and EEM, oh my goodness, what a year that will be. If that happens, this will be my best year by far. From the bull market rally that we timed in May to the put spreads that we put in March for swing trading, this has been an awesome year in swing trading. Never had if this pans out too, it'll be like one of my best swing trading years. Lots of opportunities, big moves, and as long as you had patience, these moves came to you. You just had to be patient. Okay, you have to be patient, and you'd have to really manage risks so that and there and a lot of these positions had initial drawdowns. And so, legging in, being patient, really relying on data was the key, I believe, to this year. I said it from last year. You guys knew me from some of the other Discords. I said this. This is going to be the year of the quant fund. This is the year of the quant. Okay? This is the year of data. I've been saying that. So, and I think next year is going to be opposite. Next year is going to be, I think, a DGen year. It's going to be day traders year. I think, we're going to switch strategies up. Once I see those signs, boom, we're going to switch strategies, okay? We're very liquid here. Checkmate trading, we live by that mantra. It's all about strategy, strategic positioning, and looking at what the environment is and acting based on that, okay? We don't use the same weapons over and over again for a different war, okay? If the market conditions change, we change our strategy, all right? So far, I haven't seen that yet. I'm just anticipating of what may be, 5 or 6 moves ahead. But right now, I still think this is a very awesome position. I still think there's a lot more meat ahead. But again, it could chop. It could chop a little bit and then come down, okay? So we'll see. We'll see. But those are my current positions right now. That's my current thoughts, my current plans. I'll open it up now to questions. Any questions, comments, rude remarks? Go, go, go. No? I think I see someone typing. Nope. Okay. So, all right then. In that case, I'll stop the stream. I'll hang out here for a couple of minutes, just in case if there's any stragglers who want to talk about certain trades. As always, I post these videos up on our Discord link. I'll leave the Twitch running so that you can see the data and the charts that I'm looking at. And also too, guys, if you're watching us on YouTube or Twitch, join our Discord, join the conversation. We've got a lot of talented people here with different styles of trading, and we'd be more than happy to have you trade and bounce some trading ideas with us. So come on by, and if there's no more questions, I'll log off and we'll go from there. See you guys tomorrow.